The transition toward a low-carbon economy isn't just reshaping energy infrastructure. It's fundamentally altering the statistical structure of financial markets. If you're modeling transition-related assets using standard Gaussian linear frameworks, you are likely missing the most critical risks, the heavy tails and the regime-dependent nonlinearities that explode precisely when the market is under stress. In this video, we're diving deep into a new research framework that challenges conventional forecasting in climate finance. We'll explore how a hybrid architecture combining heavy-tailed vector autoregressions with nonlinear residual learning can capture predictability that standard models leave on the table, and why this matters for portfolio allocation and stress testing. Let's start with the economic context. The study analyzes a basket of 6 major ETFs representing the transition finance ecosystem. SPY as the broad market benchmark, QQQ for tech-intensive growth, XLE for fossil fuels, ICLN and TAN for renewables and solar, and XLU for regulated utilities. The core economic argument is that capital reallocation in this sector isn't smooth. It's driven by decarbonization policies, energy security concerns, inflationary pressures, and monetary normalization. These factors create a system where assets are interconnected, but that dependence isn't stable. It's regime-sensitive. Geopolitical shocks, policy revisions, and rate hikes can trigger abrupt repricing episodes that propagate asymmetrically across these sectors. So why do we need a new forecasting model? The data tells us. First, we have distributional non-normality. Diagnostic tests strongly reject Gaussianity. We're seeing excess kurtosis across the board. SPY exhibits a kurtosis of 4.49, but renewables like ICLN and TAN are even more leptokurtic. These are heavy-tailed assets prone to extreme realizations. Second, volatility clustering is persistent. Autocorrelation of squared returns remains significant across multiple lags, and Ingalls ArchLM tests reject homoscedasticity with overwhelming significance. Volatility regimes evolve slowly and amplify during stress. But the smoking gun is the residual analysis. When you filter out linear dependence using a standard VAR, the BDS test on the residuals rejects the null of independently and identically distributed errors. This is crucial. It means there is significant nonlinear dependence remaining. Linear models are leaving predictable structure in the residuals unexploited. This motivates the hybrid architecture proposed in the paper. We're combining a multivariate Student-t VAR with a nonlinear residual learning layer. Let's break down the methodology. The return vector YT is modeled with a linear conditional mean, but the innovations follow a multivariate Student-t distribution with new degrees of freedom, rather than a Gaussian. This is a parsimonious, heavy-tailed alternative. Economically, the Student-t specification can be viewed as a Gaussian scale mixture. There's a latent variable, tau-t, that modulates the conditional variance. During stable periods, tau-t fluctuates around 1. During stress episodes, smaller realizations of tau-t inflate the conditional variance, capturing endogenous volatility amplification. This also provides robustness to extreme observations, downweighting influential outliers during crisis periods. Now for the nonlinear component. We extract the filtered residuals from the Student-t VAR and feed them into machine learning models. The framework tests SVR, MLP, LSTM, and GRU. The hypothesis is that the conditional expectation of the residual, given past residuals, is not zero. The residual learner, F theta, approximates this remaining sequential dependence. The final forecast is the sum of the heavy-tailed linear forecast and the nonlinear residual correction. This preserves the interpretability of the econometric structure, while allowing flexible approximation of the residual dynamics. Importantly, the paper argues against treating machine learning as a black box substitute. Instead, it's a residual correction mechanism that captures the nonlinear predictability left unexplained by the heavy-tailed linear filter. The authors also discuss why they choose residual learning over explicit regime switching models. Regime switching imposes discrete latent states and abrupt transitions. In transition finance, repricing dynamics may evolve gradually, and dependent structures may change asynchronously. The residual learning approach allows for more flexible, continuously evolving residual dependence without the estimation instability of high-dimensional regime switching systems. Let's look at the empirical results. The out-of-sample evaluation uses a recursive walk-forward design to mitigate look-ahead bias. The VART-LSTM framework dominates across all metrics. Relative to the Gaussian VAR benchmark, it reduces average RMSE by approximately 33%. But the real insight is the regime sensitivity. The gains aren't uniform. During the COVID crisis and the Ukraine energy shock, the forecasting improvements become substantially larger. For TAN, the RMSE reduction jumps to nearly 47% during the COVID regime. This confirms that nonlinear predictability intensifies precisely when macro-financial uncertainty spikes. Diebold-Mariano tests confirm these gains are statistically significant across all asset classes. The framework significantly outperforms not only linear models, but also standalone machine learning architectures. Recurrent models outperform static models like MLP and SVR, suggesting the residual dependence is sequentially persistent. And while GRU is competitive, LSTM achieves the best overall performance, likely due to its ability to capture longer-range dependencies in the residual sequences. The ranking structure is telling. Performance improves monotonically from Gaussian linear models to heavy-tailed models, to hybrid architectures, and finally to heavy-tailed hybrid architectures. This supports the interpretation that transition markets exhibit heavy-tailed innovations, multivariate dependence, and residual nonlinear predictability that must be modeled jointly. What does this mean for practitioners? First, stress forecasting. In climate finance, average accuracy is less important than performance during tail events. This model shines when it matters most. The economic value is highest during periods of abrupt repricing and volatility amplification. Second, portfolio allocation. Standard mean variance optimization assumes stable covariance structures. This evidence suggests dependence shifts, especially during stress. Assets that look diversified in calm times can become jointly exposed during shocks. Models need to incorporate time-varying, stress-sensitive dependencies. For example, renewable assets are often viewed as long-run beneficiaries of decarbonization, but they remain highly exposed to short-run financial conditions and rate expectations. Third, regulatory surveillance. If linear Gaussian frameworks underestimate tail risk and nonlinear propagation, stress tests might be too optimistic. We need monitoring systems that account for heavy-tailed innovations and regime-dependent predictability. The findings support dynamic climate risk monitoring that combines heavy-tailed risk measurement with stress regime forecasting. To wrap up, this research provides robust evidence that transition energy financial markets exhibit regime-sensitive, heavy-tailed, and nonlinear predictability. Gaussian linear models are insufficient. The optimal approach is a hybrid architecture, a multivariate Student-t VAR to capture heavy-tailed linear dependence and robustness, combined with a recurrent residual learner to model the nonlinear sequential structure that persists after econometric filtering. The forecasting gains are most pronounced during stress regimes, highlighting the importance of modeling the interaction between tail risk, volatility clustering, and nonlinear dependence. Future work could explore structural connectedness frameworks, asymmetric heavy-tailed distributions, and direct utility-based portfolio optimization. But for now, the message is clear. In transition finance, you need heavy tails, you need nonlinear residuals, and you need to model the regime dependence to truly understand the risks. Thanks for watching. If you're interested in the code and reproducibility details, the authors have provided a comprehensive implementation pipeline in the supplementary materials. Let me know your thoughts on hybrid econometric ML frameworks in the comments.